Good afternoon, everyone, and thank you very much for joining us today. Both Ivan and I have self-quarantined ourselves today with flu-like symptoms, so thus the session at midday today was delayed, and we're going to be running today's session to cover off how we've been trading the market recently. We're going to go through a range of different strategies, and then on Wednesday at lunchtime, I believe it's been scheduled for, we're going to come back and we're going to talk about the specific rules to trading the strategies for the current market. So tonight is an overview session. It'll be, you're welcome to fire away with any questions you've got, and on Wednesday we will come back and we will go through the specific rules. All right. Yeah, look, incredible day today. Obviously, I was trading the market and just around the close, sort of switched off to do some other stuff for a bit, went back to it, and we had another 100 points come off on close. It's hectic out there. There's a lot of fear in the market. I guess we're all feeling it. It's unprecedented in terms of what's happening. So, it's interesting times, and I think probably as traders, it's now that it's really important that you've got a trading plan. The trading plan will protect you as conditions change, as they have, and allow you to preserve your capital. And a trading plan will also equally, hopefully, give you the confidence that you need to be able to then go back to the market and extract value. Because in markets like this, we've noticed across our book, there have been some people that have suffered. By and large, our trading book has done very, very well in this last period, and some people have had some enormous gains and have done incredibly well. And so, but it's tough times, and we know that when we're trading, we've got to preserve our capital, but probably more important than our capital is our confidence. So the confidence we know how to make money tomorrow, then you can have a bad day today and you know that, you can get back to it. So anyway, tonight we're going to cover a little bit of territory. Some of it will be repetitive for those of you that have been on sessions with us before, but we need to make sure that some basic information is given so that people that are new to this can follow as well. If you're sitting on this session tonight, you're an investor, not a trader, or you're someone that's new to trading, we've got, you can jump on a trial of our platform, and there's a whole education section in there, and go through that education, and it will catch you up on everything that you need to know, or most of the things that you're going to need to know about trading. So there's a bunch of resources in support. My name is Patrick Nelson. I'm the founder of Reach Markets, and Ivan works alongside me running the Reach trading business. And my background is I've run one of the busiest desks in Australia, I say, for a decade, and I used to say that, but our desk in the last period of time, one of the busiest trading desks in Australia again. So, but previously more of a full service type operation. Now we have a full service desk, but we also have an online trade business which has got a range of different supports around it as well. All right, so with the education partners for the stock exchange, we've built and spent a lot of time and energy and effort and money building the leading technology for options trading in Australia. And, really at the heart of what we're about is helping people trade in the way they want to trade. And sometimes that's being a stockbroker, sometimes that's trading online, sometimes it's a combination of the both, sometimes it's using online tools to come up with your own ideas and then discussing it with someone. It doesn't matter how you go about it. What our aim really is to create a way access that you need to give you the edge to successfully, and thus we record lots of it. A lot of time researching the market, researching data to try and find ways of identifying an edge for our clients, and then building tools around that as well. Any advice contained in the presentation is general only, doesn't take into consideration your personal circumstances. You need to decide for yourself whether if you past returns, you're not an indicator. All right. We also give you the cheapest options brokerage available for direct trading in Australia. And what that does is it means that you can trade an online strategy like the one I've got in front of you, called an Iron Condor, and at rates that you've never been able to do so before. and we've built a lot of tools around valuing options, premium, heaps of different back testing tools. We've built tools around scanning the market to identify trades, the ability to go and back test any strategy you want to test, and we create our own quant tested trade ideas. And so if we ever say something or have an opinion on a type of strategy, there's some there are some instances where this isn't true, but by and large, if we're putting together a trading system, we'll have gone back and spent a lot of time and energy and effort in back testing, all right, and and checking the trades and making sure that we can give you the data on how successful it's been in the different market conditions that it's been faced with. So for those of you that are brand new to options, I'll go through this very quickly, but pick all of this education stuff on via the portal. And if you want to get access to the trading platform, just type in yes into the chat box, and we can organise to give you access to the platform and so forth. Right? So just simply type in yes, and we'll get you sorted out there. All right. So, and also as we go through, if you want access to any of the trading rules or trade systems, or any of our trading platform at any point in time, just type in yes, and we'll get you sorted out. All right. So there are two types of traded options in Australia: calls and puts. Right. So call up, put down. The analogy was a telephone. To make phone, put it up. To close it to it at the end, you put it down. Pull down. It's a simple way of remembering it, and gives us exposure to leverage. So leverage allows us to take a small amount of money and get a significantly larger position. That leverage means that I can take, instead of going out and buying a small amount, taking say $60 to go and buy some CBA shares that used to be a lot larger amount of money that needed to be spent, but I can take a much smaller amount of money and speculate on the fact that I think CBA is going to continue to fall, or I think it's going to bounce from here. And then I can also use options in tandem together to give myself a strategy that gives me a wider chance of being successful. And interesting, Ivan, on this chart here, this is one standard deviation either side.
Yeah, correct. Hey, mate, but yeah. By the way, just quickly, your sound is breaking in and out, so I think your internet connection is a bit flaky.
Yeah.
But yeah, I've just been a couple of people have noticed that. But yes, that is one standard deviation, correct.
Yeah. Okay. Yeah. Apologies. Well, apparently, Ivan, yours is better. Do you want to take it over and do the talking? I'll try and.
I might have to when you're done with your education stuff. Just go completely off the cuff.
Right. So anyway, as a trader, we personally, when we trade, we observe price data, technical analysis, and we don't use a lot of different tools to do so. But just for those of you that are new to it, I'll run through this quite quickly. But we have a range. We generally, most of the time, we're not going beyond here. All right. So we look at support and resistance levels, which are telling us where we're expecting buyers and sellers to get in and take control of the market. So by drawing a line under it, I can get a feel for, a trend or an uptrend or a downtrend or a resistance level, or the fact the market's channeling, or give me a range of different information that I can use to make decisions. Moving averages are a very common tool used by traders, probably most popular with trend traders. And basically they allow us to smooth out the price action by filtering out the noise and give us a view of the overall trend. And the major thing that we're generally looking at is, can I identify, so in a bearish sense, to know that the trend is there, it's saying that the shorter term moving average has crossed over the longer term moving average. Bullish, the shorter term has crossed over on the upside. And if there's consolidation, you might see the share price consolidating between the two. But so a bullish is referred to as a golden cross, and a bearish as a death cross. Right? In the current market, the market's been very bearish, but the moving averages really haven't had time to respond to this. right? And as a result, you'll see what we're seeing at the moment, where there's a bearish move on, but the moving averages are just starting to look like they're about to cross over. ADX is another thing that we look at, and really probably the simplest way of talking about the ADX is it's telling us whether the trend is absent or whether it's or weak, or whether it's strong or very strong or extremely strong, right? So what we want to see is it's above a certain level. And the other thing we look at is candlesticks, and really, if we see the green and the red just telling us what the price action for that particular day is, we like to be able to look at it. And that then, once we're looking at candlesticks, let's just look at a chart, look at a longer period of time, all right? And so that's by way of introduction what we wanted to just sort of very, very quickly go through to make sure someone that was getting onto a session, it was the first time they're hearing about options or technical analysis, had some basics down, right? But I think really what we want to do at the moment is just have a look at what the market's been doing and talk about what we see and what we think are the types of strategies that we're moving towards using, the strategies that we think will be the ones that are most likely to be successful going forward. Now, we trade a number of ways. One is we trade with where we're looking at strategies that look like, either that we're trading the volatility, so we think volatility is really high and it might go lower. We're trading direction, i.e. we think there's a breakout, or we think volatility is low and we think it's going to go high or higher, right? And at the moment, because of the significant move that's happened in the market, there have been trades that have met our trading rules, but by and large, like everyone else, your trading rules are built for more normalized scenarios. So to be able to not get completely freaked out and need to leave the market, you need to think about what sort of adaptations you can do to your trading rules to mean that you can work them into the current market conditions, all right? And so what we want to do today is, first of all, start off with having a look at the trading system and the I guess the trade that we had open on the XJO and look at that. And I guess also look at why it's so important that we start thinking about being able to be in the market in the next period of time, and the types of trading strategies that you'd look at. Now, so we're going back to the 20th of Feb, right? So it doesn't seem that, it seems like a lifetime ago, but it's, it's only a couple of weeks ago. It's just shy of a month ago, and a lot's happened in that time. On the 20th of Feb,
I made my greatest call ever.
Yeah. Well, Ivan and I were both sitting in a trade group, and unfortunately we didn't do this trade that we're about to talk now. I did a straddle, and Ivan was talking about doing a long strip. I don't think he got around to actually putting his trade on.
I had a few things going on in my life. Jesus. Yeah. Restructuring the whole company while we're at it. So, anyway.
Yeah. Excuses. Anyway. But at that point, but for our traders, one of the strategies that we do a lot of is breakout trading, right? And one of the challenges for Ivan and I at this point in time was, and we probably shouldn't have been listening to it, but was that we both were talking about our major concerns that we had for our economy, and we were both amazed at what was going on with the market, because we had clients that run businesses that, hotel owners or a whole range of different businesses. Some of them might be online, so I'm not going to quote off stuff now, but a whole range of businesses. And a lot of people were talking to us about how the fact that orders were getting, we're losing orders, major orders, and having all sorts of problems because of coronavirus, right? And we'd seen what was happening in China. We could see people couldn't get things delivered. There was a whole heap of stuff going on, right? And yet the market was going to new highs. And so we were a little bit worried about that. And volatility was also at, like it was at 11% when I got into my long straddle, which is ridiculously low, considering where are we now, Ivan? I think puts were trading at 73% this afternoon. They're a bit higher now, based on what happened this afternoon.
Matches are like 93 right now, but it's obviously in the last week of expiry, but yeah, you're sitting 60, 70%. Like that's proper GFC levels, Like Lehman Brothers, I think, got to 70 from correct. Hopefully someone can correct me if I'm wrong, but yeah, it was like over 70, but that was, collapse of a major liquidity provider, like in a kind of massive fire sale type time. So yeah, volatility is properly driven up.
So at that point in time, our trading system, as it does, follows the rules and entered into a bullish position. Ivan went for a slightly different trade, Joshua just put in, I put 22,200 into a put options at the end of Feb because of coronavirus. It's now sitting at 32k profit now. Haven't sold yet and won't for a few more weeks, I think. Well done. Well done, Joshua. That's a awesome trade.
And holding on is what I love about that. That's brilliant.
Yeah.
That takes some serious courage to hold on after a point
but the
32% drop. It's good.
It's huge. Yeah. So
it's huge.
In this instance here, this actually met all of the rules that we would have for a breakout trade, right? So what do we look for? We want to know that the market is trading above the 52-week high, which it did. It breached there at 71, whatever that was, 71.50 roughly. It broke out on that particular day, and the share price is trading above the 50-week moving average. The moving average it's been in a golden cross for a very, very long period of time. ADX was strong. Everything lined up for what we call a lit long, which is in this instance was an at the money bull put spread. So we were selling, buying at 71.50 and selling at a 7,300 put option. And when we set that trade up, the max profit was 4,765 and the max loss was 2,735, right? And so, and to be fair, every time there's a breakup, everyone's always talking about when it breaks the 52-week high, all of the reasons why it's not going to go up any further. So it's just that this time we were as well. But if you followed the rules, and there was quite a few people that did, you would have been going long into this trade, right? So that would have been, knowing what happened next, quite a scary sort of proposition. So we got into that trade on the 20th of Feb. The following day, it came off slightly, and so you were worse off $148. It then came off significantly, right? So $1,200 worse off, and then we broke through. And at that point in time, we would then buy back our sold put. So on this particular trade, the rules are if it breaks the 50-day moving average, then we immediately buy back the sold leg, and that puts us into a bought put, which takes us from a bullish strategy into a bearish strategy. All right. So in the back test here, I can close that position off by buying it back, and I now have a 71.50 put option. All right. So in that instance there, if we keep tracking forward, the following day I'm now in profit. It fell off significantly again, so we're now in 5,786 profit, and we can see that would continue on from there. All right, so that gain, if I keep clicking forward, And you can see that takes you up to 52,000 on this particular day. All right. Martin, the cost of buying the putback, Ivan, can you give that price?
482. I'm on, yeah, 482.40. So yeah, so you're 250 points off on that one.
Yep. All right.
Oh.
So there you go. So that's a trade. And so the biggest profits we've ever had trading with our system is where we get it wrong, right? And what we're going to be showing you on Wednesday is the version of this which is for bearish markets and how you can position yourself. We're modifying the rules slightly because of the move and the way the moves happened. But we ultimately want to be in a position where we can trade the market. Otherwise, you're going to be sitting there and you're not going to be able to trade at all. You've got to trade the conditions that are in front of you. And so we'll be seeing bearish trades. We'll be trading bearish trades, but also equally be in a position where, how do I know where, okay, this is now moving in the other direction, and how do I capture it on the upside and switch to be able to benefit from if there is a rebound or confidence entering back into the market, how do I position myself to be able to be part of that move? Because a move or if there is some confidence that comes, I'm not predicting that, saying we trade what we see, that there is a way of being able to do that. All right. So that is the, I wonder what happens if I click through from here.
It doesn't matter, no, it's expired. But so the one thing that I want to go and point out on that, the big thing about having a trading system is just to be able to go in and reduce that emotional attachment. Obviously, right now, everyone is very emotional. You know, I was going up the street coughing and people are looking at me kind of going and about to hit me with a hammer. You know, we're in a, you know, look at the toilet paper and whatever else. So that's one thing. The second thing is one thing that was a question that came up a little bit earlier from Matthew was, can your platform allow short on the ASX 200? So I think that's probably where we should start looking at now, Pat, just really talking about how you can go on and position yourself in now. So that was sort of where we were at, and now, you know, for a lot of our trading systems, we're sort of, you know, there's the signals that are coming up, and actually maybe you bring up the trading scan screen just quickly, but there are trades that are coming up. By the way, as we're speaking, S&P 500's locked limit down on the futures, so it looks like it's going to start off pretty bloody. We just had stops taken out below 5,000, so while we were talking, dropped another 50 points or so on the futures. So interesting times. So AGL is lining up. There's a few others that also I think were lining up just before. So that's really, you know, in terms of going in and shorting, the way that we typically get into these trades is we look at sort of more precise trading. So, you know, one way, and so my background is a futures trader, and so I started during the GFC. So, you know, for me, these are sort of markets that I've been waiting for a long time, and then they excite me. But you know, if you're sort of futures, then you're really kind of in that what's called Delta 1, which is, you know, you get short in the market bounces 500 points. That's a lot of money that you're going to put up just to keep your position alive or consistently be monitoring. Nowadays, you know, it's a lot more sort of passive, and that's where options are really good, because you can have some of these, you know, inherent stop losses. You can look at trading stocks that you might want to trade otherwise or even invest in. So there's a whole magnitude of stuff that you can do with options that ultimately allow you to sleep well at night, or just sleep, which, you know, I can wholeheartedly guarantee that I've never done before. And then in terms of how much money to start, well, we've got accounts that are sub $10,000 that have started. We've got accounts that are over $1 million. So there's really probably a wide variety of examples. But
so that was, Ivan, you've just slipped that in there amongst a lot of other things. But the question someone asked, and might be relevant for others, was how much do you need to start? And Ivan says, I think it's $10, which I would agree. That's probably around the but it's really up to the individual. We certainly don't give any personal advice as to what amounts is suitable with someone. But I think why Ivan is saying 6,000 is it's enough money for you to be able to do a number of different strategies. And one of the things
I said 10.
You said 10. Okay, sorry.
I said 10.
10. Well, you know,
yeah. I said sub 10,000.
Yeah. Okay. But around that level allows you to get going where you can spread your risk out over a few different trades, right? And so if you're trading 24.95 on Bro, then, you know, and trading online, then it allows you to have a number of different trades so not have all your risk in one basket. But certainly if you start with smaller amounts, you need to watch your risk. Always you need to watch your risk, but smaller amounts you need to probably be trading in more of a conservative fashion. Than someone that's got maybe slightly more. All right. So, Ivan, let's go and have a look at some of the types of strategies that you might look at the moment. So we were talking about, and we'll be going through this in the session on Wednesday and giving you some rules and so forth associated with it. So on Wednesdays, we're going to give you the rules for lit shorts and teach you how to do that trade. We're also going to have a look at some trades where we might be starting to position ourselves around some volatility positions, right? So did you want to go into any, I might look at the XJO, you want to have a look at CBA?
Well, actually, I think maybe start with the XJO because, you know, one of the questions is ultimately, you know, what are we doing at the moment? Last Thursday, we started going into an XJO, Iron Condor expiring this Thursday. We ended up going into that, we ended up slightly changing the legs. So what we ended up doing is we had a 5100, 5600 sold legs in Iron Condor. I mean, no surprise, vol being sort of above 75 of implied volatility on the index, considering we've been sub sort of 15 for, I don't know, 11 years, is really saying that, you know, for us, we're on the same side as the market makers. This is the reason why this is so exciting being an options trader right now. Uncertainty drives up implied volatility, and we love trading implied volatility. The kind of stuff that you're getting out of the market right now is just such awesome fatty premium that, you know, this is, you know, it's something Patrick always says to me. He goes, you know, if you're in financial services, and you know, and you're doing stuff like we've been through this massive bull market, everyone's going to make money. Well, for now, as an options trader, this is the time when you make serious money, and you do that ultimately by trading volatility, these massive spikes, and also what effectively 75% implied volatility means is that over the next 12 months, the market is pricing in, there's a 68% chance that we end up between, 5,000 times or 1.75, so 8,750, or the same on the downside, so about 2,000, right? So, I mean, seriously, I think there's probably more like a 99% chance that in the next 12 months, we're going to be between 8,750 and 2,250, right? So I think that's firstly the most crucial element that you've got to start considering. So if the market is pricing in a 68% chance and we think it's like a 99% chance, then clearly implied volatility is starting to get mispriced. Everything's getting wider and we want to be sellers of volatility. So I think that's ultimately where we're positioning ourselves. Now, how do you trade it is then the next question. So one way to do it is if you're seriously you're flat out, and the thing that you're looking at is, okay, well, the market is going to go on and stay between a certain range. Whatever that range happens to be, we can go and price up an Iron Condor off the cuff, you know, one that expires on Thursday. Let's say you think the market's, you know, going to be 4750, 5,500, for example, right? Even something like that typically won't go and generate any kind of premium in a normal market for you because it's like, okay, 250 points, 500 one way or the other. Let's go price that up. You know, something that expires on just for the sake of doing it. You know, 26th of March. 19th of March. Do you want to go into the strategy builder, Patrick?
Sure.
Yeah, I'm just quickly doing this as well. Just quickly adjusting that, but you're going to find that even something like that, which typically you just shouldn't be making
right, so
any money
slow
on.
down. I don't know what you mean by that. Do you want me to just put it into the options cookbook, or do you want me to price it up from here?
Do an options cookbook and then we can adjust it.
All right. So you're talking about doing a bull put spread, yeah?
No. Just a straight iron condor.
Wait, all right.
At the moment.
All right. So
we'll go into we'll go into bull puts and stuff.
10
Yep.
days expire.
26th of March. Yep.
March.
That's pretty. Yep.
All right. So.
Except you just did a CBA.
Except I'm doing it on CBA. Yes. All right.
Other than that, we're all fine.
Other than that, perfect. All right, let's go
Yeah.
here. All right, so if I'm going to put an iron condor on, I go to the cookbook. All right, so 31 days.
Just do that, and then we'll push it back to 16th. So just on the expiries up next to the iron condor, you see that minus plus? I got to get you doing this properly. You're going the wrong way as well.
Yeah, there you go. I don't know. All right.
You're in May.
All right.
Other than that, we're all good. No. Sorry, can you just check that expiry? Just press that -1. This next, right there. Just take that back to 19th of March. So this is literally expiring in 3 days. Yeah, and then change your strikes to 47.50 on the sold.
Yeah.
5,500.
Yeah.
And then let's do wings. Let's say, let's take that one to say 5,600, 46.50.
46.50. And
5,600. No. So take that one to 46.50. That put. Other way. 40. Yeah. We're getting there. And maybe they make that call at 5,600, just so it's 100 even points each way. So this is seriously. So this is expiring in on Thursday, and you're saying that I don't think that the market isn't going to fall more than 300 points on the downside from sort of these levels where the futures are at, and so going to go up more than 500 points. So, that's a serious risk reward there. This is typically, you just don't get that kind of premium typically in a market. So this is like next level risk reward. This is a 2-to-1 for 2 days, or effectively 2 trading sessions. That's crazy. So that's just one point around about trading implied volatility. You're just getting benefits now that you just wouldn't get otherwise.
so that means, Ivan, that if the market is, where are we? You're at max profit at 47.69. And then on the upside, I need to lift that up a bit. Anyway, I'd have to finesse that, but you can see for yourself, your break even's 47.15 and 55.35. It's a
exactly.
It's a wide range.
It's extremely wide. So and you can go on and take that down, right? So if you look at the premium, you're getting sort of 130 for the call side, which is 500 points away. Your puts you can go and increase and decrease as well. The only way you might want to have a bit of an upside skew is because you get sort of that double whammy where the volatility would probably drop off if you're getting a bit of a move higher. There's some interesting stuff. So that's sort of one. The second thing that probably is worthwhile then is saying, okay, well, if you think about an iron condor being created as a put spread and a call spread, sold spreads albeit, so one way to do it is then to start thinking, okay, we're getting these big bounces, and so maybe you don't have to go on and look at executing the whole spread in one go. So if you sort of do a quick calculation, you know, you might want to say, okay, I think that the market is going to move from 5,000. 5,000 is going to be its line in the sand, and it's going to bounce over the next period of time. Well, then maybe then the strategy is to start saying, okay, well, what is that going to be? So let's say maybe we take it out to the 26th of March. So maybe, Patrick, you want to go +1 on the expiry? Actually, maybe just do a bull put.
Sorry, mate. What do you want me to do? You want me to do a bull put or stick in here?
Yeah, let's do a bull put. Let's do a bull put. So let's then make the strikes say 5,000 and 47.50. And so just the only levels that I'm picking there. So 5,000 will probably be the. I'm just saying. So let's go back to the assumption that I think that 5,000 might be the line in the sand, and I think that it's going to bounce from here over a period. Okay, April's probably fine as well. And then if it drops below 47.50, well, then it's the end of the world, and I definitely don't want to be part of this trade. The reason why we would be doing a sold spread here is just because, again, as volatility starts coming out of this trade, you're going to start getting, 4,700, then I guess, yes, there's no 47.50 created. That's good. So then you'll a trade like this. Again, typically a trade that you just won't get that much value out of. Typically, as long as the market goes up as long as the market doesn't drop by more than 120 points from here, between now and April, you're going to make somewhere between 0 and 1,100. So again, massive upside, and if volatility starts getting dragged out of this index, so if that sort of starts really grinding higher, you're going to be profitable in the trade a lot faster as well. So again, massive skew ultimately. And then if you want to have slightly more aggressive trades, you can lift that bought leg from 4,700 to say 4,900. So you're very much you're much more committed to that trade going up. Maybe Patrick, if you can go on and lift that from 4,700 to maybe 4,900, you'll get a couple more lots on that. And then now you're seeing that risk reward is more like 1-to-1, so 450 to 550. So again, another opportunity there worth considering. So from there, I think now it's probably time to start looking at single stocks. Actually, just on that, maybe before we do run off, if the idea is you want to start legging into iron condors, so you want to play the volatility, as the market bounces, you'll lose a lot of that value out of that puts. You'll start doing the same thing with bear call spreads to execute the second part of your iron condor. And then if you're thinking that it's going to be a range-bound neutral trade, you can get a lot of premium. So instead of doing an overall iron condor for around about 60 points, you'd end up doing that's priced at 45.80, that 5,000, 4,900. As the market pops up, you'd probably be doing the same at a 5,500, 6,000 level, wherever it happens to be. So you end up getting a lot more fat out of these iron condors, worth looking at. Anything to add to that, by the way?
No. I just think if you're trading in this market, the high vol scenario, as long as you're trading on the right side of it, gives you the ability to use, and I would be suggesting that you think about using smaller amounts when you're trading. So you can do a trade which might, and spending shorter periods of time in the market if you can. But I would definitely be saying it's a period of time where you could get a couple of trades wrong, or you could get them very, very right. And so you want to work on the basis not that you want a high percentage of your trades making you a heap of money, but that you can make a lot of money off one or two trades. So if you give yourself the best chance and line yourself up in the right direction, you can make a lot of money trading these conditions. But if you put a big chunk of your bank, or maybe even just a normal amount that you would normally trade with into your trading bank, that because so much is happening, that it can impact your bank and your confidence pretty quickly. So I'd definitely be urging people to trade with smaller amounts in the current market. Be conservative from that perspective, but don't necessarily be conservative in terms of the size of the percentage gain that you can make. Right. So you might not be looking at where you might have lined something up for a 20 or 30% return. You might be lining it. Think about, the normal distribution that might occur being very, very different to what's happening now.
I think it's a really important point. It's so important. I mean, the volatility in itself means that, you've just got to be able to get 2 or 3 really wrong and be around, because right now with so much bouncing around, if you're just literally playing the ranges, there's a good, with moves that are 15% either way on a day, even that stuff didn't even happen during the GFC, right? We were getting sort of 300-400 pound sell-offs, which was sort of 7, 8, 9%. This is, you can see now we've had since 1987, the biggest crash happened the other day. Before that, 1929 percentage-wise in the US. Like, these kind of moves are crazy, but you got to be on the right side of them. So, or at least be ready to be. You've got the wrong screen up, by the way. Do you want to let's have a look at a single stock? We're going to be talking about doing bearish trades on Wednesday. A good question from Martin. Not considering bull call spreads. All right. So the difference between a bull call spread and a bull put spread is ultimately the volatility element. So if you're trading a sold spread, ultimately what you are expecting on some level is a drop in implied volatility, whereas a bull call spread is effectively and so I understand the implications, and it sounds, you can get them to work pretty much the same way, but a bull call spread is ultimately you're going and saying, okay, I'm going to go and buy a call option, and then you're sort of capping that loss. Capping that maximum profit on that trade. Whereas in light of current volatility, you really want to be splitting that up. Now, the better trade overall is an iron condor, and I wouldn't be just going into a straight sold spread on its own. But I think that you've just got to think about it. You're trading volatility more than you're trading direction at the moment. And while there are things you can do there to get long in the market, with the volatility with where it is, take the market maker approach, right? They're owning the underlying as a way of deleveraging that volatility. So they're making their money in the difference between options and the underlying. Another question. So there's no market for options bid and offers. How can I execute my strategy? There's still market makers. It's still a little bit harder to get in there. They're not quoting quite as much, Frank, but there's still enough market maker support in there to go on and execute, albeit it's a little bit harder. When you go on and put on a trade, there's interesting sort of opportunities. Let's have a look at a single stock, and then we can answer sort of the balance of these questions. I think, Patrick, what do you think?
Yep. All right.
I think one that I was looking at just before we were sort of thinking about which stocks we're going to be using as an example. I think CBA is a pretty good one. So might have to type it in there, by the way. But CBA is an interesting one in the sense that it's just dropped to the levels that we haven't seen since sort of the middle of 2013. And I know that a lot of people are looking at ultimately buying CBA into their portfolios on some level. I know that I bought stocks for the first time since 2009 the other day, which was a pretty big moment for me. But the thing about CBA that was interesting.
I think all the people in Hawthorne just jumped onto Netflix.
Yeah, exactly. I think you're right.
You'll have to wait a sec.
No, that's fine. That's okay. So CBA is an interesting one in the sense that, so let's say that you want to go on and actually, or you're considering buying the stock, or I should probably rephrase that. So let's say that you're comfortable owning CBA if it goes below 60 broadly. One way to go on and trade this is to say, okay, well, how many shares are you looking or happy to buy? Let's say the answer is that you're happy to go on and buy 200 shares. One options contract is worth typically 100 shares. So you can trade 2 lots of a spread. You go on in and sell. If 60 is a level that you're happy to go on and own at, or just below 60, you can go in and say, okay, I'm going to go in and sell my $60 put options, which means that if the over X amount of time, let's say till the Thursday expiry next week, CBA drops below 60, you'll end up owning 200 shares at $60, very similar to like a limit order. And then you can go on and say and put in an inherent stop loss. So let's say that that stop loss is 50. So I'm happy to own my shares if it goes below 60. I don't want to own them if they go below 50 over a certain period of time. So the world's over, that kind of scenario. One way to go on and do this, and this is where options are awesome. You need to change that to CBA before you do that. Patrick, you're still on External. But I'm watching your screen very closely. So it's 59.72 right now. Be interesting when the market again opens up yesterday. The markets are getting absolutely clobbered. Let's go 26th of March. So like, really kind of short term, you're getting super quick time decay. And again, you're at these levels where you probably you'd probably be happy to hold on because you know that CBA is going to go higher than 60 at some point in time. So let's pick a 60. 60.01 is a good idea here because it's slightly in the money. It's a European option, so you can't get assigned too early, so it can't break your strategy. And 50. So market falls below 50, you'll end up having no obligations for stock. Can you change that ratio, the quantity to 2 as well? Because we're talking about 200 shares.
Sorry. Go again.
Just in the quantity, can you change that to 2 shares? Two. Yeah, just one more. Cool. So that means that if anything happens, you'll end up owning 200 shares at $60.01. Now, in return for that, for taking on that risk, you're going to get $732 out of the market, or $3.66. So that's, if you divide $3.66 by 60, that's 6.1% return on the options right now between the 16th and next Thursday, right? So that's sort of where the levels are at. Now, if the market goes and bounces, this is where you can go in and modify the strategy, and where you can go in and, again, because of volatility is so high, you can start selling a bear call option around about your 70, or depending on how much that strike is, you might want to go and consider that. But right now, I think that this is one way to go in and combine what you'd ultimately be doing out of your equities versus what you'd be doing out of options, and get some massive returns out of it. Now, having said that, if the market goes and rallies from here, and you won't end up owning any stock at 60, so there's a risk you've got to consider. But as long as that rally is somewhere below $63.67, which is the strike, the sold strike, plus that $3.66 you're going to get out of that market, that means that you're still going to be in a position where you're better off. Who's against a 6.1% return in 10 days? I say you're all for it. Question on that is selling European and buying American intentional. Yeah, so on the European option, it goes below 60.01. If you don't want to get assigned ahead of that time, ahead of the 26th of March, and you only want to get assigned on the actual 26th of March, if the stock is below $60, you'll end up getting assigned on that $60 only on expiry day. With the American, it's your right to go on and exercise that option, so it doesn't matter. You might not. There's no value in really paying the premium. So when you're doing a lot of spreads, I typically go on and do this if it's sort of a little bit closer to at the money if I can. The bigger stocks have European options that are liquid. You'll get filled on those. So there's some background noises, by the way. My son is trying to break into my study that I'm trying to hide at. So that's massive. Trudy just asked, can we have a look at the same strategy on Macquarie?
Sure.
So I thought that, one of the things that Patrick and I were talking about is, instead of sort of talking about straight bear options and bear trades, which you can get over a period of ways, One thing actually, maybe just one thing to just before you do that, can you just go into the filter and do a volatility falling in the cookbook, just a filter on that. If you go to the cookbook and go filter by volatility, bearish, you get the scenario. You can go and see. These are all the different options that you get that benefit out of volatility coming out of the market. You'll see the lit shorts and lit longs, and we'll talk about them on Wednesday lunch. And one of the big things about that is the repair becomes really crucial. So we're going to talk about the repair in light of volatility so high. But the interesting thing is that second strategy on that, by the way, is a stock with a collar over it, which is effectively the same payoff as a bull put spread. And this is again, if you already own the stock, this is a good way to go in and say, I'm going to protect my downside, but I'm going to go in and get my my premium out of it. If you already own the stock, you might be looking at covered calls. But anyway, let's look at the same strategy on Macquarie. I think you're right, Treat. I don't think there are Europeans there on Macquarie. But let's do a bull put. Thanks, Josh. Yeah, I've got lots of vitamin C, and I'm in quarantine, so I'm no threat to anyone anymore for the next couple of days, at least, until my results come back, and then who knows.
Yeah.
So again, so here maybe just to be a little bit safer, considering that there are no Europeans, maybe the level is probably around about 100, right? Although there you go, you do have some Europeans there created. Now, by the way, if you're really keen on doing this tomorrow, so there's 101, but you can actually go in and get us. We are able to go in and create the strikes in these times as well. You need to bear with us. It takes time from the time that you request to create the European strike to the time that we actually get it done. It's got to flow through stuff, but ultimately it can be created in the market. So if you're looking at this and saying, look, I want to go in and sell a 99.01 strike or 99.51, they could be created as long as there's an American strike around it. Same kind of strategy, 100. Maybe we do it a little bit higher. So Macquarie has the potential to seriously move really quickly. I'd probably keep that American option, stop a little bit higher. What's the next one? You can go maybe 95 or something, 92. So is there a 98 maybe? Yeah, 98 would be awesome. So that's I mean, like, if that moves, that's going to go and take a serious move lower, you would think. But you see, interestingly enough, you just don't get enough out of that. So you only get about $1.82 on that trade. So you might actually. What if you go to a 92 or a 93? How does that change? What's the theoretical on that? Yeah, so that might be worthwhile. So by adding a little bit to that stop, so that 93 is going to be 282. If you take that, yeah, 281.5. So that's probably the way. Yeah. So Josh, yeah, the CBA is better, but 280. That's still 2.8%. The way that you can go on and find us, by the way, very quickly, is if you go into the stock screener, Patrick. There's a bit of magic that you can do. So sort by the second last one, which is volatility. And so there you go. So everything that's got a high volatility there, that high implied volatility, is where you're going to get the most amount of premium out of this stuff. So Macquarie, interestingly, is right up there. Where's CBA? CBA is 100. And you can just go and price these. So anything in the top, like for anyone who's interested in saying, okay, well, Afterpay, for example, has been absolutely creamed. Maybe I want to go on and own some of that. This might be the screen to start looking at. So, have a look at stuff that you're interested. If you're happy to go on and own some of this, some really good opportunities. If you don't want to own it, then the simple adjustment there is to go on and say, I'm going to go on and move this a little bit lower. And so instead of, say, for example, 100 on Macquarie, you might want to move it down to like 90 and have an iron condor type trade around it. That's probably the other way to look at it. But look at stuff that's going to be what you want to do is you want to be putting on the bullish side on stuff that is a little bit more stable and less likely to go in and drop significantly from these levels. And then when you're selling the call side, you want to be doing that on the stuff that you think is going to be probably too much jump higher and is more volatile. So oil search, for example, just picking that one on there, which just dropped 20% today. You know, that's stuff that's really susceptible. Actually, can you go and change sort by the price, absolute price change for today, which is the third button on it? So you got name code price change. There. So have a look at that. So Star dropped 23.5%. So those are interesting. So what, you know, in terms of looking at companies that are really weathering the storm now, WiseTech's fallen so much that you were looking at before. Coles was up there. You know, interesting. So Star got absolutely smashed today. That's 24%. Oil Search at 20. Worley. You know, Sydney Airport, I wonder why they're going down along with Flight Centre. You know, Santos on the back of the, again, further oil weakness. You look at these stocks, these are the ones that when you're going to look at selling your call side, as they bounce up, that's the stuff that you're going to be looking at. So if you're looking at, you know, sort of creating these legging into these iron condors, look at the banks, for example, if you're looking at the banking sector, Bank of Queensland, that's becoming, you know, as soon as there's a drop off, this is stuff that's moving the most. And then as you're buying it, you're going to be in these situations where you might get a lot of value out of buying stuff like CBA and selling things like Bank of Queensland as they bounce up. Do you agree with that, Pat?
Say again.
About buying, as you're doing these iron condors, effectively buying the things that you want to own, like CBA, and selling the call spreads over things like Bank of Queensland to the same level, which are more susceptible to strong moves lower when the market's bouncing around. Yeah,
look, I think that generally in this current market, the way that that I'd be doing it is simply trying to find something that I can understand a range on. Me personally, I just wouldn't really have too much of a view on owning anything. As you know, I don't own anything right this moment. It's listed, or maybe one or two things. But so I think that you know, I'd be more interested in just being able to narrow in on a range on something, and you know, if I can get a trade like the one Ivan showed before, where for 3 days I've got to sit in the market and it can finish within that range. It might go up above and below in that period of time, but do I think there's a high chance in 3 days it will be in there? Yeah, that ticks the box for me. Instead of putting like you know, 5 or 10 grand risk on it, I'd probably be more inclined to say, well, I'd risk 2 grand or 3 grand on it, and more inclined to be able to do, instead of 5 or 6 trades over the month, I might find the opportunity to do a few more, right? But you get that wider range and so forth. So it'd be just, you know, I think, you know, we'll come back and talk to you about some of the technical things we see and some rules around the setup of it. But I think that trade that Ivan showed before on the Iron Condor that's the type of thing that I'd be looking for in this market. And but you know, we obviously, we don't have crystal balls and so forth, but those opportunities are there. They won't have worked every time if you look over every period. And you might also look at, say, if we start to find some sort of consolidation, we haven't yet, but if we find some consolidation, you might then start thinking about putting in the bull put at as low a level as you can get it, and then maybe even bringing a bear call in on the other side of it if you get a move up, and then moving your way in and out of those types of positions. I think there will be a lot of that type of trading happening over the next period of time, but we'll need some sort of consolidation before that occurs.
Yeah, definitely. Couple of last questions that were probably worthwhile answering. How do you determine whether to use more technical strategies like these or just simplistic trades like just a put option? based on research, gut instincts, and wider trends like the negative effects of the coronavirus, like the lockdowns. Most important thing to watch out for, again, is volatility. Buying single options, like you could get the direction right now with you can buy a call option and volatility drops off. You'll actually end up overpaying for that insurance policy so much that you'll end up still losing on it. So it's very important you consider it. Use the matrix for that, the payoff matrix, to see and just stress test it back to its levels just to see the impact of, if I buy a call option and it drops 50%, in volatility, what happens. So that's very important. So you use your vol adjustments in the matrix. In terms of whether you want to trade, the fundamentals are out the door at the moment. I don't think there's any value in looking at research unless you're buying stock with like a 5-year or 3 to 5 to 10-year horizon. We're in extremely volatile periods. Typically, the only thing that holds up is to some extent is technical levels. One simple example is as we started this Webby, we had the SPY futures were trading about 5,000. They took out a level despite the fact that S&P is already limit down, so they can't go any lower until the market is done. It's dropped another 50 points in aftermarket, right? So this kind of moves typically didn't really happen in the past when over the last 11 years or so. So these are markets where they're more technical than anything else. You've got to look at the technicals. So definitely. Tony mentioned the iron condor for AGL, 3,500 return to $500 risk. The volatility is massive. IV rank is high. You're getting a lot of value, a lot of premium, to the point that you can actually go in and reduce the values, widen the spreads. You don't have to go half a standard deviation. You can go 1.5, because that's typically what the market's moving at the moment. Again, massive. Even right now, we're looking at Macquarie. Have a look at that IV over HV at 2.1 in the middle of the Macquarie stats. That's showing that the implied volatility right now is twice what typical historical volatility's been, and you just don't get that kind of stuff. So, iron condors are fantastic. The question ultimately, I think, right now is whether you leg into them or not. With stocks, you can probably go on and leg that in, because worst case scenario that happens is you end up owning some stock that you probably wouldn't mind owning otherwise. That's the only reason why I'm picking single stocks at the moment. Otherwise, you look at the XJO, Pat, you beat me to it. You look at the XJO and you look at the stuff that right now it's just that's where the market's at. You don't want to be a buyer of options. You want to be a seller of them. The people that ended up buying put options in the last couple of weeks ahead of the move, massive. So I think that's congratulations to everyone that did that. And we had a fair few clients that we saw doing that. I think that's the best way to do it. Was it this volatile in the GFC, limit down, up, and then down? The futures used to trade a little bit differently, but the circuit breakers were a lot wider. A lot of that stuff got reintroduced after. It was very volatile during the GFC, but there was an old theory that I read from some quant analysts the other day, which was that 2/3 of a bear market happens in the last 1/3 of that bear market. And I think it's probably fair to say that in this instance, if this is going to be a serious bear market or a serious pullback, I think it's probably fair to say that the big chunk of the move has already happened, because even if we're halfway through that move, we're down to 3,000 below the GFC levels, right? If I'm doing my maths correctly, 2,000 points, yes, we'd be at sub 3,000. So, so I think that's it just traded a little bit differently. I think that, I have a lot of, I've been saying this for so long now, and people have been criticizing me for it, is that this whole passive investing thing, the downside to all of that is, although it's great you get diversification, but then you get this extra concentrated amounts into the top 200. So as soon as you start getting a sweep out, this kind of a move was always going to happen as soon as there was some catalyst. Okay, maybe I'm not saying that it was going to be a 30% move in 16 days or 32% move, but it was definitely always going to be a serious move. Where are the support levels? I think the thing that I would say to that is probably wait for a bounce. So I'd actually be looking, if you're looking to buy this market, I don't know if Pat, you will agree with me, but I'd actually be buying a breakout of a resistance level. So if you have volatility going down, and let's say, for example, the market closes consistently, or closes above 5,500 and does that convincingly, that's what I'd be looking at, as opposed to trying to buy a 48.80 level, because if that gets taken out, you're not even going to get a chance to get out. So that 48.80, 44.30, 2,000 might happen very quickly. The market is not thinking rationally, and learning from the mistakes that I've had, I typically be that guy buying that 48.80 level and then trying to get out of it at 48.50, and then you get emotion starts coming in the way. So unless you've got a very predefined narrative, or if you've got a very tight stop, or if you're trading options and you're committed to doing that one particular thing, I'd say that you'd be much safer buying the market at 5,500, even though it's 10% higher. Would you agree with that, Patrick?
Yeah, definitely.
Yeah. I think it's just these kind of movements, it's the market could be trading, you're going to laugh at me, but it could be trading at 6,500 before the end of the financial year. Do you know what I mean? Like, this could all just blow over, the market continues to rally, but then, okay, you missed out 500 points on that move. But, okay, but then we've taken out some serious resistance levels. So I think it's just, you've just got to be very mindful of what you're doing. And if you're doing that kind of stuff, if you're buying the low, or if you're trying to time this and buy the low, do it with extremely tight stops.
Yeah, I think finding technical levels at the moment, we're all feeling our way towards them, right? It's kind of like saying, let's say CBA came out tomorrow and said, "Oh, we've just discovered a problem with our reporting, and we're not going to make a profit. We're going to make a loss this year." Where do you find a technical level for CBA after that statement's made? Like, it's a complete black swan event. It's completely unexpected. The implications aren't understood, and while it remains in that, in that vortex, then finding levels is difficult. Yeah.
Yeah, I agree. It's just, I mean, this is yeah, in this kind of market, it's definitely so hard, and it's literally, we are in a swing trader's paradise, and in particular, adding to that high levels of implied volatility. No matter what happens now, is that we're going to be in this. There's going to be bounces. There's going to be we saw that on Friday briefly across Australia and then US ultimately, where we had that massive rally into the close around about the same time, or that same day that I gave you coronavirus, Patrick. It was, those kind of moves are just going to continue happening. And you're going to get these volatile swings. And that's where there's just value in being a seller of volatility and looking at trying to try and get a little bit more out of some of these.
You don't have coronavirus, Ivan.
Yeah, sure. Okay. Well, whatever it is.
Yeah. Look, I think it's the things. We'll come in and we'll give some rules. And I think we've probably been running this session for long enough tonight. So thank you very much for everyone coming along.
Yes.
We wanted to do an introductory session and then run a session based on more specific rules. We were trying to do it in one day, but unfortunately we could not. But we want to, we'll come back on Wednesday and give you some trading rules around it. But what I would say for anyone who's in the market at the moment or looking at going in and doing some trades, use smaller amounts of money and try and plan your trades over shorter periods of time. Be very mindful of volatility. It's high. You don't want to be going long vol. or maybe you do, I don't know, but there's not a lot of room for movement. It can swing back quickly against you, so be very mindful of that. I would definitely be trying to avoid strategies where at the end of the trade you rolled into another trade, especially if it wasn't a good trade for you. So there's a lot going on. I don't know, Ivan, would you add anything else to that?
No, I think that one of my favorite trading rules is just make sure it's all about defense, not offense. Especially now more than ever, don't think about your upside that you're going to make. Just go on and look at the maximum losses and just be sure that you're around there. As the guy used to, I think it's Jim Rogers, one of those guys was saying that it's all about making sure that you're going to be around tomorrow. So make sure that the risk that you're putting on the trade is that. You can make some fantastic upside in this market. You've just got to make sure you diversify your trades. Don't go long CBA, Macquarie, NAB, and ANZ, because guess what? If something happens, they're all going the same way. Diversify across sectors. Try a couple of different things. Trade small, and this is seriously, and as that version, I'd be more forceful and say, yeah, you don't want to be buying vol at these levels. I could be wrong. It's happened before, but I think that just the kind of moves that this has been, there's a bounce in here somewhere, and it's a drop in vol. Where it comes from, I don't know. We're going to open about 4,900 at this point in time, if futures are anything to go off. Interesting times.
Cool. If anyone wants to get access to the platform, take a trial, get access to our trade ideas, we're going to be doing a whole much more webcasts as part of our service. Type in yes and get you access to that. Otherwise, thank you very much for coming along tonight, and we hope to see you all back on Wednesday to get into the right into the detail around all of this. Cheers. Have a good night. Thanks, Ivan.
Thanks, mate.